Let's look now at how we deal with the unrecorded liability. So we've got a section here a paragraph here that tells us that the subsidiary was involved in a court case with an entity that was claiming damages from it. Subsidiary has not raised a liability in relation to any expected damages. So in the subsidiary accounts, for this liability, there's actually no amount included. However, the parent company measured the fair value of the liability at $5,000. So from a group perspective, it has a value attached to it of $5,000. And this is now on the acquisition date. By the end of the financial year, so 6 months later, the expectation of winning the court case has improved. So the fair value was now considered to be only $1,000 at year end from a group perspective. So on acquisition, we would have made a fair value adjustment of $5,000. By the end of the year, we need to record the fact that that liability is now only assessed to have a fair value of $1,000, and that we've actually realized a gain from a group perspective. This adjustment in value of the liability is dealt with in the BCVR entries for the current year. So there's for this unrecorded liability, in the subsidiaries accounts, there's 2 adjustments that need to be made on group level. The first being to raise that liability in the consolidated financials, and we know that the value attached to that liability is $1,000. The reason being that from the subsidiaries accounts, there's no amount going to flow through to our consolidated financials for this liability, but from the information in the question, we know that on a group level, a value of $1,000 has been attached to that liability. So we need, through our BCVR entries, an adjustment of $1,000 to get us from the zero to what it should be from a group perspective. Okay, so that's $1,000. We raise a deferred tax asset and we make the adjustment against the business combination valuation reserve, because this account is used for all our fair value adjustments from the business combination. At the acquisition date, this liability, however, was valued at $5,000. So from a group perspective, this reassessment and devaluation of the liability actually results in a gain of $4,000. So the $5,000 initial fair value to the current fair value of $1,000, that adjustment. We reverse the deferred tax asset for that difference, which was recorded on acquisition date, and then by de-recognizing that liability, we transfer it from the BCVR reserve to retained earnings. So almost similar to de-recognizing an asset, just in the other direction, the other way around.